You've launched your freelance videography business. Your schedule is packed, cameras are rolling, and money is constantly moving. But a serious question starts keeping you up at night. You feel flush with cash because a client just handed you a deposit, but you also just signed a promissory note to finance a massive gear upgrade. Are you actually turning a profit, or are you secretly going broke? To answer that, you need an accounting information system. It functions like a professional athlete recording their performance stats. Without reliable, organized data, you cannot spot the leaks in your game. The core scoreboard of this system is the fundamental accounting equation, visualized here as a perfectly balanced scale. On the left side, we have assets, everything your business owns, like cash and equipment. On the right side, we have what you owe others, your liabilities, plus the remaining value that belongs to you, which is equity. These two sides must always equal each other. No matter how frantic a wedding shoot gets or how many invoices fly out the door, your survival depends entirely on making sure this specific equation never goes out of balance. To maintain that balance, we rely on the dual nature of accounting. Every single financial action you take creates an equal reaction elsewhere in the business. Every dollar has a specific source and a specific use. We track this action and reaction using a T account. The left side is labeled debit, recording the uses of your resources. The right side is labeled credit, tracking the sources of those resources. Let's see this in practice. Say you buy a $9,000 camera and $1,000 worth of memory cards, paying with $10,000 in cash. Your cash balance decreases, so we record a $10,000 credit to show the source of the funding. Your new equipment and supplies increase, so we record those as debits. The total assets haven't changed in value, they have just changed form. Now, you shoot a wedding and immediately walk away with $1,500 in cash. Receiving that cash increases your assets, giving you a debit. The source of that cash is your work, so we balance it by increasing your earned revenue with a credit. But what happens when you receive a $2,000 cash deposit today for a wedding you won't shoot until next year? You have the cash on hand, giving you a debit. But because you haven't actually provided the service yet, you owe that client a wedding video. That cash creates an obligation. We record the credit in unearned revenue, which is tracked as a liability, not true revenue. Tracking a handful of T accounts is quite easy, but a bustling business generates hundreds of transactions a month. In the real world, accountants tackle this by first recording these daily events chronologically in a master diary called the General Journal. Once recorded, they perform a step called posting. This means copying the data out of the chronological journal and sorting it into the general ledger, a centralized collection of all your specific individual T accounts. Together, the journal and ledger act as a filtering pipeline. They take a chaotic pile of isolated receipts and transform them into a unified, trackable database. At the end of your first month, your ledger now tracks 10 full transactions. You've brought in an additional $3,500 from a dance competition and paid out $2,250 for advertising and wages. To prove the math is accurate, we build the trial balance, a master summary of every account's total. The rule is absolute. If total debits exactly match total credits, reaching $31,000, the physics of your business held up. Your accounting equation is secure. This trial balance data now feeds directly into the creation of your final financial statements. First, the income statement. Taking your $5,000 in total revenue and subtracting advertising and wage expenses reveals your true net profit of $2,750. Then we stack your total assets against your liabilities and equity to build the balance sheet. Seeing both sides reach $27,250 proves the business is stable. Accounting provides the vital translation of physical hard work into reliable data. It is the evidence you need to know that your daily hustle is actually building a secure, lasting business.